Good afternoon, everyone. So I am Kolawole by name. I'll be taking us source documents and accounting equation today. So let me present my screen. Please confirm when you can see my screen. Can you guys see my screen? Hello? Can you see my screen?
Yes, sir.
Okay, so I'll be starting with source document. So source document is just the original document that contains details of business transaction. That is, it is the document that details each transaction that an entity enter into, be it sales transaction, purchase transaction, any form of transaction. Source document is that document that evidence that transaction, that it is just an evidence of a transaction. So a source document captures the key information about a transaction, information such as name of the party involved, amount paid, the date of this transaction.
We can't hear you. You muted yourself.
Hello? Hello? Please, can you guys hear me? Hello?
We can't hear you. We can't hear you.
Okay.
So confirm when you guys can see my screen. Confirm when you guys can see my screen. Can you guys see my screen? Hello? Hello? Please, someone should say something. Can you guys see my screen?
We can see your screen, sir.
Okay. So to start with, I think okay, Joshua, Zainab. Okay. So I'll be taking you guys through source document today, and if time permits, I'll also be taking accounting equation as well. So what can give me the definition of source documents? Anyone? Well, so to save us the time, a source document is the original document that contains details of business transaction. That is, it is a document that detail all the transactions that an entity engaged in doing a financial year. So that is, it contains those information that has to do with the names of the entities or parties involved, the date, the substance of the transaction, the amount involved, and all. It's just that document, and that that serves as the evidence of every transaction that an entity engaged in during a financial year. So we now have different types of source documents. We have credit notes. A credit note is a type of source document that is usually issued by a seller to a buyer or by an entity to its customers when the customer returned goods back to the entity. You know, a customer could return goods back to an entity due to different reasons. It could be due to the good not meeting specifications, or the goods in question. It could be a damaged goods as well. So a customer could return goods due to any reasons to an entity. So the type of the document that will be issued by the entity to the customer for the goods returned by the customer to the entity is a credit note. Then we also have a debit note. Well, a debit note is usually issued by a seller. Excuse me, sorry. So is a document that is usually issued, or a type of source document that is usually issued by a seller, detailing a debt that a certain buyer is owing the seller. That is, it's just like a reminder from the seller to the buyer that, okay, so amount is being owed by the buyer to the seller, and the amount is expected to be paid in so date. So it will detail all of those things in there. You see all of those things in such a debit note. So the difference between debit note and credit note is that a credit note is issued when goods are returned by the seller by the buyer to the seller, while a debit note is usually issued by the seller itself when as a reminder to a debtor. So the next one we have is bank statement. A bank statement is a statement that detail the inflow and outflow from the entity bank in a particular financial year or during a particular period of time. That is a statement that shows it shows details of inflow into the bank statement, maybe cash received by the entity, or maybe cash paid into the bank account of the entity by its customer as a result of goods sold by the entity to the customers, or maybe it could also show an outflow from it. That is, it could be outflow from the bank statement to a vendor or a supplier. When the entity buy goods from a vendor or a supplier, and the entity is expected to make a transfer to such a vendor or a supplier, the bank statement will show the details of such transaction. It will also show details of successful transaction, failed transaction, or reversed transaction. Some transaction could also be reversed. It could happen in a situation whereby an entity make a payment to its vendors or supplier, but due to some reasons, such amount was reversed back. All of that, you see that on the face of a bank statement. A loan statement is another source document. It's usually detailed. It could be a statement by the entity. It could be a statement that is issued by the bank to the entity detailing the loan, the amount borrowed by the entity from the bank, or it could be a statement that detailed loan given by the entity to its employees. So it will show the amounts, it will show the total amount borrowed, the interest, and of course, it will show the amount that has been paid, that amount that is yet to be paid, and the amount that is expected to be paid on a regular basis. So a loan statement will show that such detail. Sales invoice. A sales invoice is usually a sales invoice is also another source document, which is usually issued by an entity to its customer as a result of the sales transaction between the entity and such customer. That is, when a customer purchases a good from an entity, it's just like a receipt that detail the goods purchased by the customer from the entity. So it will show the amounts, the quantity of goods, description, the sales invoice number, name it, all of those information, you'll find it on on the sales invoice. A purchase invoice is also a source document that is usually issued by a vendor or a supplier to an entity. A purchase invoice usually show it's usually detailed the same thing as I've said earlier on for sales invoice as well. That is, on it you see the dates, the transaction occurred, the quantity of goods purchased by the entity, the price of the goods, the description of the goods, the purchase invoice number, all of that, you see it on the face of a purchase invoice. A purchase order, well, before you purchase, I think the purchase order ought to have come first before the purchase invoice itself. So a purchase order, when an entity wants to buy a good from its supplier or vendor, the entity will raise a purchase order. The purchase order will show the breakdown of the quantity of good the entity intends to buy from its suppliers or vendor. It will show the price, the agreed price between the parties, that is between the entity and the vendor in question. It will also show the value of the goods, which is obviously the quantity times the price of the commodity. So all of that, you see that on the purchase order. So it is usually sent by the entity itself to its vendor or a supplier when the entity wants to purchase a certain good from its vendor or supplier. So after this good has been purchased, the next source document that will be raised thereafter from the end of the vendor of the supplier will be purchase invoice. So the purchase invoice is just like a receipt. While the sales order is usually issued, as the name implies, order. When a customer wants to place an order, a sales order will be sent by such customers to the entity, or it will be sent by a buyer to a seller, detailing the quantity of good. Hello?
Please, what is the meaning of entity?
Well, sorry. Okay. You could, okay, I think the perfect example, I'm using an entity. Let me say, okay, is the same thing as seller. Do you understand what I meant? In this context, maybe I should be using buyer and seller. Do you understand that? Will you prefer me using buyer and seller instead of entity?
Yes, sir.
Okay, let me be using buyer and seller then. So for a purchase order, let me go over that again. If a company wants to buy a good from its vendor, that is its supplier, the company in question, okay, entity in this context can be used interchangeably for, what is it called? A company in this context can be used interchangeably for entities as well. So if a company, let me assume that I'm a company and I want to buy goods from my suppliers. My supplier is also the same thing as vendor. So if I want to buy goods from my supplier or vendor, I will issue a purchase order to the supplier that, okay, this is the quantity of goods I intend to buy. This is the type of good I intend to buy. And this is the price that we both agreed on. So after purchasing that good, the supplier in question or the vendor in question will issue a purchase invoice to the entity or the company in question. Do you understand that, Zainab?
Sir, yes.
Okay, so the next one is now a sales order. A sales order is usually a source document that is usually raised by the buyer in question, that is the customer. When a customer wants to buy a certain goods, so the customer will send an order, so we call it sales order, to the entity or the company or the seller. Choose anyone you think you're best with. So the buyer will send a sales order detailing the type of good they intend to buy, the quantity of the good, the price of the goods, and of course, the price of the good will be based on what the seller and the buyer has agreed as agreed between one another. So the sales order will be sent by the buyer to the seller that, okay, stating that I want to buy this type of goods, this quantity of good, and this at an agreed price. So after this goods have been sold to the seller at the point of sales, the seller, after these goods have been sold to the buyer at the point of sales, the seller or the company or the entity in question we issue a sales invoice to the buyer. The sales invoice serves as the receipt for the goods sold by the entity or the customer or the seller to the buyer. Do you understand that? Hello, Zainab?
Yes, sir.
So the next one is now deposit slip. A deposit slip, just like anytime you go to the bank and you feel a teller as a result of you wanting to deposit a certain amount into, it could be your personal account, it could be your business account, it could be that you want to send that you are depositing that money into another party account. After depositing such amounts into the account in question, if you go to bank, I think the slip are always like 3 or thereabouts. So you're going to dump one into, they have a particular place you dump one into. So the cashier also will hold one and the other one will be given to you. That slip given to you is a deposit slip and is also a source document. Is an evidence needed when passing, is an evidence that is very much needed at the point where you want to pass your accounting entries. Do you understand that? Hello?
Yes.
So the next one is
Yes,
now
sir.
importance of source document to different financial information users. I guess my colleague put you guys through, as explained, I've gave different examples of financial information users that we have. So you need that knowledge here as well. If the best approach that I think we can adopt for this is, you need to know all of this, the types of source document that we have. You need to know the different users. With that, you know the importance of the source document. Let me take a credit note as an example. As I've explained earlier on, I said a credit note itself, as the name implies, is usually issued by an entity or a seller to a buyer when the buyer return a certain goods. So bringing that to importance of source documents, the importance of source document context, you could say that, okay, it is, you could mention any of these source documents and you say that, okay, the importance of it is that it detailed the goods returned by a customer to an entity or a seller. Of course, it will show the price of such good returned and all. So it all boils down to, if you know the user of financial statement, then you will be able, that will help you to tailor the importance of source document to such users, because different users use this source document for different reasons. An auditor, for an example, we all know an auditor is a person that is saddled with the responsibility to give an opinion on the financial statements of an entity, to give an opinion whether the financial statement of an entity show a true and fair view. So, and hello, Joshua.
Hello, sir.
Yes.
What's the difference between sales invoice and receipts?
Well, the
sales invoice and receipt.
Where they are, you can't really say, okay, like purchase invoice is a receipt on its own as well. Sales invoice is also a receipt. I shouldn't have put that in there. Do you understand? You know, when an entity or a company in question want to buy goods from its suppliers or a vendor, the first thing the entity is expected to issue to the supplier is a purchase order that, okay, I want to buy this type of goods at this agreed price between us, and I want to buy so quantity of this type of good. After this purchase has been made, the next thing that is the vendor or the supplier will issue to the company or the entity in question is purchase invoice. The purchase invoice is a receipt that will detail the quantity of good purchased, the price per good purchased, the description of the good purchase. Of course, it will also show the purchased invoice number. There is always a number to every purchase or sales made. You always see a number on it. Do you understand? Joshua? Hello, Joshua, are you there? Okay. Joshua, do you understand?
I've gotten it.
Okay, so
Yes, sir.
as I've earlier explained, for you to know the importance of each of these source documents, you need to know the different users of financial information that we have. For an auditor, the importance of all of these source documents to an auditor would be that, okay, when an auditor is meant to review the financial statement of an entity, then give a professional opinion on the financial statement, whether it shows true and fair view. As such, the auditor during its audit process will request for all of these source documents in order to vouch each of those transactions on the face of your on the face of different ledger accounts. Ledger, as we all know, ledger is a permanent account. So all of those transactions on the face of our ledger account, all of them, of course, have a source document which serves as an evidence to each of those transactions. An auditor will request for the source document for the purpose of review. A company as well, a company that purchased good from its supplier or a vendor, the company also needs this source document. Is also important to such company because the company will try to compare, okay, this is the purchase order given to that I gave to the supplier in question or the vendor, and this is the purchase invoice. So the company will need the purchase invoice in this question, in this instance, to compare the two, whether they are the same thing or not. So that also serves as one of the importance of source documents. So source documents are used for various reasons. It is used by auditor to carry out its review process. It is used by an entity to vouch the order placed by such entity. It is also used by customer. It could be used by customer to make claims for discounts, name it. Do you understand? Hello, guys? Zainab, Joshua, any question on source documents? Any question? Joshua, you want to say something?
No question, sir.
Okay.
No question, sir.
Zainab, what of you? Are you there?
Yes, question, sir.
No question. Or is there any of those source documents that you want me to explain further?
No, sir.
Okay, no problem. So the next topic that I will be taking you guys today is accounting equation. I need you guys' attention here because the foundation, we all know that the foundation of accounting is double entry. And if your double entry is not sound, then if your double entry is sound, to me, like with double, if you're very sound when it comes to double entry, then you are 70% there already. And of course, accounting equation is an important aspect of that. If you understand, of course, and if you can also digest your accounting equation that, okay, when I see this, what is the next thing to do and all, you won't have issue. So accounting equation is like the foundation of your double entry. So let me present my screen on that. Okay, Can you guys see my screen? Zainab and Joshua, can you guys see my
Yes,
screen?
sir, yes, sir.
Okay, so
Yes,
what
yes,
is accounting equation? Accounting equation, as the
Yes,
name
sir.
implies, usually show the relationship between elements of accounts. What are the elements of account that we all have? We only have 5 elements of accounts. Element of the financial statements, which are assets, capital, liabilities, income, and expense. All of these are usually called elements of financial statement. So what is now accounting equation? So accounting equation shows the relationship among all of these 5 elements of financial statements. Are you guys there? Do you understand that? Or you need further explanation than that? Hello? Zainab, Joshua. Do you guys need further explanation on that?
It's okay, we got it.
Okay, so the next thing, I think I've mentioned that already. I've defined accounting equation to be, it shows relationship between or among the element of the financial statement. So the next thing is now component of accounting equation. We have 3 components of accounting equation. But if you further break it down, we have 5 major components. So the component of accounting equation are assets, capital, and liabilities. What did I say the component of accounting equation is? Assets, capital, and what? Liabilities. So those are the 3 major accounting equations. But if we drill further, that is, if we break it down further, we actually have 5 major components of accounting equation, which are also known as element of financial statement. So what is an asset? Asset is a resources a company has that hold a future benefit. That is an asset in question. Anything we call assets, before you can say that something is an asset, the entity must be able to generate future economic benefit from such thing. If the entity won't be able to generate any form of future economic benefit from such thing in question, then you can't say that that thing is an asset. Do you understand? Hello? So assets, we have current assets and non-current assets. As we all know, current assets are assets that are expected to be consumed within 12 months period or the next accounting period. Current asset can also be defined as a cash and cash equivalent. What is cash? We all know what cash is. Cash equivalents are highly liquid short-term investments. What did I say cash equivalents are? They are highly liquid short-term investments. Perfect example of that is treasury bill that will be due within 90 or 180 days. Any form of investment that the lifespan of such investment is within 12 months, or that will be consumed, that such investment will be realized within the next accounting period. Such investment is said to be classified as a cash and cash equivalent, short-term investment. So it is usually referred to as cash and cash equivalents. Do you understand? So the next one is now our non-current asset. They are assets that an entity are expected to consume for more than one accounting period. That is for more than 12 months period. So as I've said earlier on, assets are resources a company has that hold a future economic benefit. I said before you can say an entity, an asset hold a future economic benefit, the before you can say anything hold the future, anything hold the future economic benefit, it must be a thing that the entity will benefit either from the use of it or from the sales of it majorly. So the next thing is now liabilities. Liabilities are obligation of a company to pay money owed to a lender as a result of previous transaction. Of course, you can't say that the emphasis on previous transaction. An entity, there can be liabilities if an entity has not engaged or involved himself in a certain transaction whereby the entity didn't pay immediately. So it must be as a result of a previous transaction. So a liability is an obligation from the end of an entity. That is just what the entity is owing other parties. It could be a third party, it could be its supplier and all. So all of that are called liabilities. So anything that the entity is owing other parties, or anything that is a seller or a company is owing other parties is being referred to as liabilities. So the next one is now our capital. Capital is the company owner's residual interest in the assets of an entity after all liabilities has been deducted. Normally, the definition that I gave you guys on liabilities and assets, and of course, capital to an extent. If I'm to go by accounting standards, those definitions are not, it didn't capture, those definitions didn't actually capture like the definition of like assets. That is not the main definition for an asset, but at your level, because I'm taking you guys based on WAEC and JAMB standard, and of course based on the recommended textbook. So I can't just go beyond that. And of course, in between, I'll be chipping in one or two things. So as I've said earlier, capital is a residual interest of the owner of the business in the assets of the business after all liabilities has been deducted. So, which means in essence, if you know your assets and liability, then you can get your capital easily. Assets minus your liability will give you your capital. So, Zainab and Joshua, you guys still there?
Yes, sir.
I hope you guys can see me. Do you have a question? It seems.
Yes, sir.
Okay.
So what is the meaning of accounting equation? Can you please repeat it?
I said accounting equation, by as the word, just like the word, as the way it sounds. It shows relationship among different elements of financial statements. You can say that something is an equation. Of course, a relationship must exist, right? So accounting equation just show that the relationship between or among the element of financial statements. And what are the elements of financial statements? Assets, liabilities, capital, income, and expense. Those are the 5 major elements of financial statements. But if I'm to, based on accounting equation, of course, it shows relationship between asset, capital, and liabilities. But if you do further, you can break that down further. So our accounting equation, so I've explained the component of accounting equation. The next thing is now the accounting equation itself. The formula, as the name implies, accounting equation is just assets equals to capital plus liabilities. That is, in essence, if you know, if you know 2 out of this, you'll be able to get the other one. So if you don't know your assets and you have your capital and liabilities, the addition of the 2 will obviously give you what? Will give you your assets. But if you know your assets and liabilities and you don't know your capital, then assets minus liabilities, we are minus your liabilities will give you your capital. But if you know your capital and assets, and you don't know your liabilities, assets minus liabilities, minus your capital will give you your liabilities. So far you have 2 out of these 3. You can get the answer for the other one. So your accounting equation is your asset equals to capital plus liabilities. But if you further break this down, you know, Joshua and Zainab, I want you guys to on your mic. I need to ask this question so that we can be on the same page. Joshua, okay. So you know, on the face of your balance sheet, we have the left-hand side is the liability side, while the right-hand side is the asset side. And on your liability side, the first thing you start with is your opening capital, right? Zainab. Hello? Joshua. Are you guys there? Well, let me continue. So the first thing that you start with is your opening capital. Then add any additional capital during the year, plus your net profits minus your drawings, right? Those are just the component of your capital. So that is why I said our accounting equation says that asset equals to capital plus liabilities, but you can further break down that capital itself. And based on, you guys can see my screen, I guess. So if you further break down your capital, then your assets become equals to assets plus open brackets liabilities minus drawings plus profits. Don't forget, just if you know your balance sheet offhand, and if you know it perfectly well, like the format of it, it is usually opening capital plus additional capital during the year, plus net profits minus your drawings. And of course, before you can arrive at your net profit, you must have deducted something from it. You know, your net profit is coming from your income statement or your statement of profit or loss. The two are actually the same thing. So your net profit, before you arrive at that, your net profit is usually your income or revenue minus expenses, right? Zainab, Joshua.
Sure. Yes.
Your net profit is your income or revenue minus expenses, right? So that's your net profit. I just want to show you guys different ways that examiner might comes from when testing or asking questions on accounting equation. You know, they might not give you the normal thing which is asset equals to capital plus liabilities. No, they might not give you that. That is just kind of straightforward. They could give you your drawings, your revenue, and your expense. And if they give you that, then you should know how to maneuver your way around it and get what you want. So your assets will now be equals to, if you further break down your capital down, as I've said, it will be capital minus drawings plus profits. You can still further break it down. That is that profit part of it. It will now become assets. It will now become assets equals to liabilities plus open brackets capitals minus drawings. Open brackets, your profit is usually your income or revenue minus your expenses. So with that, if you get that, then you can now open your brackets. So your formula will now look like assets equals to liabilities plus capital plus revenue minus drawings minus expenses. So in order not to cause any form of confusion, you could make positive to be on one side. You could make the two sides to be positive. That is the asset side and the liability plus capital side. So, and to do that, your assets will now become assets plus drawings plus expenses will give you your liabilities plus capital plus revenue. This is even the last formula that you need to know actually. If you know that, then you are good to go when it comes to accounting equation. That is your assets plus drawings plus expenses will be equals to liabilities plus capital plus your revenue. And I need to state this. I said earlier, as I said earlier on that if you know your accounting equation very well and how to go about it, then your double entry is as good as anything you can think of. We all know your double entry is just talking about the debits and credits that we all know. So note one thing, assets, drawings, and expenses, they usually have a debit balance. What do I mean by they usually have a debit balance? That is, for every any asset or expense or drawings related information, anything that will increase anything that will increase an asset account or an expense account or a drawings account is expected to be debited, right? Zenob. While anything that will reduce, right, Zenob?
Sir?
Anything that is expected to increase your assets, drawings, and expenses account is expected to be on the debit side, right?
Yes, sir.
While anything that will reduce it is expected to be on the credit side. So
Yes,
if you get the difference between the two, your what is it called, your balance brought down is usually on which side for assets for a normal account on the debit side. Oh, sorry. Yes, your balance. Yeah, is your balance brought down? Actually, it's usually on the debit side for asset. The same thing for your drawings. The same thing for your expenses. So that is why we usually say that those three forms of accounts usually have a debit balance. The same thing goes for your liabilities, capitals, and capital and revenue. Those three sets of accounts, anything that has to do with those three, usually have a credit balance. That is, their balance brought down will always be on the credit side. Do you understand? So any accounting related transaction, name it. Name any accounting related transaction in this world. It will fall into these 6 major components. So if you know this, okay, if you know that asset is expected to always have a debit balance as such, anything that will increase asset account is expected to be debited, while anything that will reduce it is expected to be credited. The same thing goes for drawings, the same thing goes for expenses. If you know that, then you're good to go with your double entry. The same thing for liability. Liability is normally anything that is expected to increase liability. That is anything, an increase in liability, you see it on the credit side. But anything that will reduce it will be on the debit side. The same thing goes for your capital. The same thing goes for your revenue. So any transaction in this life, name it, you end up classifying it under these 6 major components. So it's very important that you guys note these things very well. That is, what if an asset increase, what is it, which side is it expected to be, and if it reduce, which side is it expected to be. With that will aid your double entry. When we get to double entry, I think that will be taken in another class. So when we get there, you guys will understand this very well. But with this, you need to be groomed, and you need to be well grounded when it comes to your accounting equation. So if you know these 6 major components, that is this 6 major breakdown of it, then you are good to go with your accounting equation. So let's start with the question. So new computer that costs 2,500 naira are purchased. 1,000 is paid upfront in cash, and the rest is paid in account. Let me explain that to you guys. The 2,500 naira computer that we bought, of course, is an asset. Then I said, out of this 2,500 naira, 1,000 naira was paid immediately, which means the remaining 1,500 naira was paid later. As at the time the transaction occurred, that 1,500 is a liability. So to now pass the double entry, you are meant to debit your computer, which is of course an asset. You are meant to debit it with 2,500 naira. Don't forget what I said earlier. Anything that will be increasing an asset, anything that will increase or an asset account, a drawings account, or an expense account is meant to be debited. Why anything that will reduce your liability, why anything that will reduce the asset account, the drawings account or an expense account is meant to be credited. For your liabilities, capital and revenue, anything that will increase it is meant to be credited, while anything that will reduce it is meant to be what? Debited. So knowing that, we all know that a new computer that was purchased is an asset. So since it is an asset, and of course it is increasing our assets, so you are meant to debit your asset account, which is the computer in question. We all know that cash is also an asset, because cash is a current asset, to be specific. It's a current asset which is usually put in our financial statement as cash. Our statement of financial position or our balance sheet, you always see it as cash in hand on the asset side of it. So, and they told us that 1,000 was paid upfront in cash. What that means in essence is that out of this 2,500 naira, we've already paid 1,000 naira out of it, which means we are reducing our asset account. We are not receiving. Don't forget, debit the receiver and credit the giver. That's the double entry principle. You debit the receiver and you credit the giver. So the 1,500 that was paid upfront by the entity is paying in question. So the entity is the giver in this instance, and is giving this out of its cash. Of course, it will reduce its cash account. So you are meant to credit your cash account with that 1,000. With that 1,000, sorry, let me change it. It ought to be in naira, not with that 1,000 naira. So the remaining amount that is expected to be paid over time, which is 1,500, which means the entity has not paid it now, it becomes a liability. Since the entity is not paying it now, since the entity or the company, since they are not paying that amount now, that means the liability of the entity is increasing, right? And since the liability of the entity is increasing, as I've said earlier, anything that will increase liability, capital and revenue is meant to be credited. So credit your liability with that 1,500 naira. With that, then now substitute all of that in your accounting equation, which is asset equals to capital plus your liabilities. So with that, on your, I said something earlier on that the formula that you guys should familiarize yourself with is the last one, which is assets plus drawings plus expenses equals to liabilities plus capital plus revenue. In this question, we know our assets, so which is 2,500, but we don't have any information on drawings, so drawings is 0. We do not have any information on expenses, so expenses is 0. Expenses is 0. So we do not have any information on capital as well. Our capital is 0. We do not have any, but we have, of course, we have information on our liabilities. Our liability is 1,500. The 1,500 is coming from the difference between the cash that was paid and the cost of the asset in question. Don't forget, I said anything that will reduce asset is meant to be credited. That is, you are meant to minus it from your asset account. That is why we are minusing that 1,000 naira that was paid out of cash. Cash is a current asset item, is an asset item. We will minus it to reduce our assets. So we are minusing that from the cost in order to arrive at our account. In order to arrive at our finance, which is 1,500 equals to 1,500. That's our accounting equation. So there's another question that captures all of these components. That is the component of these formulas above, which is, I said, okay, in a situation where you have an asset to be 50,000 naira, liabilities to be 30,000 naira, capital to be 30,000, revenue 15,000, expense 10,000, and drawings 1,500. Please, can you guys still see my screen? Confirm you guys can still see my screen. Joshua, Zenob, can you guys still see my screen?
Yes, sir.
Okay. So we know all of this. Don't forget, please, you guys need to know the last formula, That's asset plus drawings plus expenses equals to liabilities plus capital plus revenue. It is very important. If you know that formula, there's no question they want to bring when it comes to accounting equation that you guys won't be able to solve. I can guarantee you guys that. So based on our formula, just substitute the figure given above. Our asset is 50,000 plus our drawings. It is the formula that is now directing you to pick the right figures. Our drawings, asset plus drawings plus expenses equals to liabilities plus capital plus revenue. So our asset is how much? 50,000. Our drawings is 5,000. Our expense is 10,000. Add those three together on the left-hand side, then equals to our liabilities plus capital plus revenue. Our liability is how much? 30,000. Our capital is 20,000 and our revenue is how much? 15,000. That one will be on the right-hand side. So the addition of these two, as we all know that we are dealing with accounting equation, which means the right-hand side must be equal to the left-hand side. It must always be equal to the left-hand side. If not, then something is missing. Do you understand? So that is why we arrive at our 65,000 equals to 65,000. Do you guys understand? It seems I can see some. Okay, we can hear you. You can't hear him. Can Hello, can you guys still hear me?
Yes, we can.
Okay, so I'm done with my lecture for today. Do you guys have any question or questions? Joshua, Zainab, and others, do you guys have any question or questions? It could be on source document, it could be on the accounting equation. Please, you guys should ask. Joshua, say something. Zainab, say something. Do you guys have any question for me? Well, since you guys are silent, I would take that to be no question.
No, sir.
Okay, no question, no problem. Joshua, what up? Zainab.
Huh?
I hope everything that you've done so far, when you are alone, you can do it yourself, right? Can you? Joshua, I mean Zainab. Well, I think we lost Zainab there. That could, I think that's maybe she is having network issue or something. So I'm done for. You want to say something? You're about to say something.
I think I don't know. I can do the solution here. I can't do it alone.
You know what? The best advice I can give to you, well, you guys will still have the video will still be sent to you guys after this class. So with the video, I think the video will be like it will be a good it serve as a good guide to you whenever you are reading. So you can always revert back to the video anytime you need any clarification. And of course, if you guys need me to explain anything further, or you guys can ask now, or you can reach out to Jason. He will get back to me then, and I will get back to you guys. You guys still have the video. I recorded the session, so you guys will have the video after the session so that you guys can go over it over and over and over again. But you don't need to bother yourself. If you know the formula, I think you are good to go.
Okay, sir.
All right. Joshua, anything from you?
Hello, sir.
Yes, I can hear you.
Yeah, I don't have any question for now. We just need to go through it and digest it very well later.
But so far, are you able to pick one or two things from what we've done so far?
Very sure.
Okay, no problem.
Sure, sir. Yes, sir.
That's good. No problem then. So let's meet another time. You guys should enjoy the rest of your day.